So let's see what we're doing here, and let's pay attention where we have our calculate keywords. Define spot rates and the spot curve, and calculate the price of a bond using spot rates. Define par and forward rates, and calculate par rates, forward rates from spot rates from forward rates, and the price of a bond using forward rates. All right, let's have a look at what we're doing here. Let's draw out what a yield curve would look like. It's sort of a generic yield curve. So here is our graph. Across the horizontal, we have the time to maturity. So we might have a 3-month security here. This might be a 1 year, a 2 year, the 5 year, the 10, the 20, the 30, etc. And each of these securities, we can identify a yield simply by looking at the yield on a particular security for that date. And we'll get to what particular securities in a second, but this is what we would do. And then we would just connect all the points and it would draw out a curve, and this is called a yield curve. It's also referred to as the maturity structure of interest rates or the term structure of interest rates. This yield curve we drew out is for a particular cluster of bonds, and in that cluster the bond should have the same currency, the same credit risk, the same liquidity, the same tax status, and the same coupon. And when we say the same coupon, we don't mean they should all be 4% or they should all be 6%. We mean they should all be either annual bonds or semi-annual bonds or quarterly bonds. We would never look at yields on semi-annual bonds for the 5-year and combine it with yields on quarterly bonds for the 10-year. That's the point of the yield curve, is that they should be as homogeneous as possible. So the same currency, the same credit risk. So for example, if we're doing corporate bonds and we're looking at bonds with a rating of A versus bonds with a rating of BBB, we would draw out 2 separate yield curves on these. One representing credit quality A, one representing credit quality BBB. You can't mix them. So same currency, credit risk, liquidity, tax status. This becomes an important one when we start to distinguish between the difference between a spot rate and a par rate. If you get the difference between a spot rate and a par rate, you're good, especially at level 2. It becomes very important. The same coupon. So if we are looking at a whole bunch of 0 coupon bonds, well then that's one type of curve. If we're looking at a whole bunch of semi-annual coupon paying bonds, well that's a par curve. That's a different type of curve. So we're going to get to the difference between these, but just be aware that each yield curve should have the same coupon. The reason why is because we want reinvestment risk held constant. All right, let's start with the government bond spot curve. These are yields to maturities for 0 coupon bonds for the full range of maturities. Now it's important, 0 coupon bonds. The government spot curve is for 0 coupon bonds, so it's also referred to as the zero curve or the strip curve. And if you're wondering, well, why is it called a strip curve? Is because we can create 0 coupon bonds by taking a coupon paying bond and stripping off the coupons and selling them as separate 0 coupon bonds. That's why it's called a strip curve or a zero curve. Now, this last point I said, every yield curve must have the same coupon. These are all 0 coupon bonds. It's going to become important in a second. So that's the spot curve. The government spot curve is for the yields to maturities for 0 coupon bonds for the full range of maturities. If we have an upward sloping yield curve, that's called a normal yield curve. In other words, longer maturities have higher yields to maturity, which should make sense. The longer I got to hold something, well, I need a maturity premium. I should have a higher yield to maturity for a longer dated security than a shorter dated security. So that's a normal curve. Sometimes the yield curve could be downward sloping. It could be flat. Typically, it would get flat before it gets inverted. But if it's downward sloping, it's called an inverted yield curve. And if you remember in macroeconomics, when we talked about monetary policy, we talked about the term structure of interest rates briefly, and we said that an inverted yield curve is a leading indicator of a recession, that all recessions have been preceded by an inverted yield curve. But not all inverted yield curves lead to a recession. All right, now this writing at the bottom in white is a bit of just a bunch of logic statements that will move us away from the spot curve to the par curve, and it'll explain I think in a very crisp way, why we have to use a par curve. The government spot curve has no coupon, so it has no reinvestment risk. But most bonds have coupons. Remember this last point. Every curve must be the same coupon so that reinvestment risk is held constant. If there's no coupon on the spot curve, there's no reinvestment risk, but most bonds have coupons. Therefore, we need a term structure for coupon-paying bonds. But older bonds may have different tax or liquidity status. Therefore, we use on-the-run bonds, but there is a limited amount of data for the full range of maturities. Therefore, we have to interpolate between dates. So what have I said here? I said that we need to create another curve for coupon-paying bonds. We're going to call that the par curve. The spot curve is for zeros. The par curve is for coupon-paying bonds. We need to create a yield curve for coupon-paying bonds. However, look up here. Every yield curve must be for bonds with the same liquidity and tax status. Let me underline that better. Liquidity and tax status. Some older bonds may not have the same liquidity, and they typically don't. They're typically more illiquid. So their yield to maturity will also reflect a liquidity premium in there. And they may have a different tax status depending whether or not you're buying them at a premium or a discount, which means that some jurisdictions treat the premium or discount as capital gains and losses. Others treat it as amortized interest, so they're not going to have the same tax status. So the way around that is to use a bond that sells at par. Then we don't have to worry about any tax status. You bought it at par, it matures at par. And we just have to figure out, well, what interest rate would have to be charged on that bond to make it par? And that's a par rate. And then we draw out a par curve. So it'll have the same liquidity, the same tax status, and the same coupon, which means if we're doing a par curve and we're using semi-annual bonds all across all the maturities, they must all be semi-annual bonds. We can't mix annual bonds with quarterly bonds with semi-annual bonds. They must all be semi-annual bonds. I'm going to repeat what I just said here because it's extremely important that you get the difference between the spot curve and the par curve. The spot curve is for zero coupon bonds, so there is no reinvestment risk. But a yield curve must reflect a group of bonds that are similar on all their characteristics. Since most bonds pay a coupon, the spot curve is not the appropriate curve to use to determine what our rates are to discount each cash flow. We want to use a par curve for that. And the reason we use the par curve is because we don't want to use bonds with premiums or discounts so that we can hold the tax status of all bonds constant. Across all of them, they all have the same tax status because they all just have interest now. That's important stuff. Let's move forward. All right, let's work our way to the par curve. But before we get to the par curve, I want to introduce just another curve, and we'll see why we wouldn't just use a curve like that. Let's just say, instead of the zero curve, instead of zero coupon bonds, why not just take coupon paying bonds? Why not just take the on the run, the recent on the run coupon paying bonds? And clearly whatever yield they're trading at must be the yield for that particular maturity. Why not just use that? All right, let's go with that. Let's see where that breaks down. Most bonds are semi-annual bonds. So we're going to have a curve that is stated on a semi-annual bond basis. That's not really an issue. We're going to look at the observed yields on recently issued on-the-run coupon-paying bonds. And for the 1 month, the 3 month, the 6 month, the short end of the curve, well, these are money market securities, but we've already learned how to convert those to bond equivalent yields. So far, those points aren't really an issue. Here's what the curve will look like. And I've drawn it out this way on purpose as opposed to this, if you look at the bottom of the screen, this smoother curve. I've drawn this out on purpose. These are coupon-paying bonds on the run. We can observe a 3 month, a 6 month, a 1 month, a 1 year, a 2 year. Maybe there's a 3 year, a 5 year. You might have a 7 year. There's a 10 year, a 20 year, and a 30 year. Those are all called key rates. Well, there is no 8 year on the run bond. There is no 22 year on the run bond. So here's what you would have to do. You have your observed yields for your particular key rates, and in between them you'd have to draw straight lines. In other words, you're interpolating between the two yields. Not a very precise way to get a rate. So you'd end up with a curve that doesn't look very nice, and you'll have a whole bunch of holes from the 10 year to the 20 year. You'll have no on the run 11, 12, 13, 14, 15, 16, 17, 18, 19 year bonds. and then you have this big gap from the 20 to the 30. So that doesn't make a lot of sense. So instead, we can move to a par curve. And the par curve is just a sequence of yield to maturity such that each bond is priced at par. Hence, it's called a par curve. All we need to get a par curve are all the spot rates. And remember, these are all for zeros. And we can create any zero by taking any bond and stripping its coupons and selling it off separately. And so all par rates are derived from spot rates, and here's how we do it. Let's take the first year spot rate and let's get a par rate. So what we want to do, in a year, we know we're going to get our payment plus our maturity, and we're going to discount it back at the spot rate, and it must equate to 100 to be a par bond. Shouldn't surprise us that the 1 year spot rate is pretty much the same as the 1 year par rate, 5.263. And I'm going to move away from saying year. Let's just say 1 period. Here, our periods are years, but let's just say by period. Let's find the 2 year par rate. The 2 year spot rate is 5.616, so we have to solve for payment in this formula where we want to arrive at 100 for our present value. So it'll be the first payment discounted back by the 1 year spot rate plus the second year payment plus the future value discounted back at the 2 year spot rate squared, and we just solve for payment. We get 5.606. So in other words, if this bond had a coupon of 5.606%, given this 1 year spot rate and given this 2 year spot rate, we would end up with a par bond. That's all we're doing, is we're solving for what the coupon would be on that bond to make it a par bond given these spot rates. Third year spot rate, 6.359. Well, we do the same thing. The first payment discounted back by the first year spot rate. The second payment discounted back by the second year spot rate squared. Then you have the payment plus the future value discounted back by the third year spot rate cubed. And we get 6.306. So if this bond had a coupon of 6.306% given this structure of spot rates, we would get a par bond. And you just keep going. You can fill out the 1, the 2, the 3, the 4, 5, 6, 7, 8, 9, 10. So off we go. Isn't that nice? Now, you would normally do this on a semi-annual bond basis. I'm just showing you how you arrive at your par rate. You arrive at your par rates by taking your spot rates and determining what coupon a bond would have to have given this structure of spot rates to arrive at a par bond. That gives you a par curve. So let's do a couple of examples here, just so that we're comfortable with what we know so far. Let's say these are observed spot rates. We have a 1 year spot rate, a 2 year, and a 3 year at 2, 3, and 4%. I'm denoting them as lowercase z1, 2, and 3. And we're going to price out a 3 year, 5% annual bond. So it's 5%, so we know our numerator is going to be 5. Since it's due in 3 years, there's the 100 we add on. Our discount rates for the first cash flow correspond to the first spot rate, 2%. The second cash flow has a 2 year spot rate of 3%, so we'll discount it at 1.03 squared. And the final cash flow, 4%, 1.04 to the power of 3. You get 102.96. Once we have an observed price, we can calculate a yield to maturity. Our N is 3, our payment is 5, future value of 100, and there is our present value, 102.96. Our yield to maturity is 3.935. So look at the 3 year spot rate at 4%. Look at the yield to maturity, 3.935. The yield to maturity will be pulled towards the final spot rate because the weight of the cash flow, 105, is the greatest on that particular time period on the 3 year spot. So it's pulled towards R3 since the weight of the cash flows are at T equals 3. Next example here, we're given some spot rates, a 1 year, a 2 year, and a 3 year spot rate, or you could say it's a 1 period, 2 period, 3 period spot rate. And we're asked to calculate the payment. In other words, what is a 3 year par rate? That would be the payment or the coupon that would create a par bond. I'm going to show you a really easy way to do this. We're going to calculate some discount factors, and the discount factors just assume that we're discounting $1. So discount $1 at the 1 year spot rate, discount $1 at the 2 year spot rate, so you're discounting at 0.57% for 2 years, and discount $1 for 3 years at 1.08 to the power of 3. Now, let's price out a $1 bond, or let's figure out what the coupon rate would be to create a par bond if we were going to issue a $1 bond. Reason we do that is because the payment will be the rate, will be the coupon rate if we use $1, right? So what is this up here? This is just discounting each of the cash flows by each of the spot rates, and then you discount the future cash flow by that spot rate. Well, we can write this term as follows. Payment multiplied by 1 over R1. You can see that these two things are exactly the same thing. We can do that with the second term all the way to the future value term as well. Well, we know that 1 over 1 plus R is a discount factor, so we'll call that discount factor 1. For the second payment is multiplied by discount factor 2, all the way to discount factor n, and then of course our future value is multiplied by discount factor n. We know that our future value is 1, so we could just drop FV from the whole thing altogether. Let's collect terms. We have payment, 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 and then we have DF1 plus DF2 plus DF3 all the way to DFN. That is payment multiplied by the sum of the discount factors plus, this should be, I'm going to correct it on the fly, FV times the last discount factor. We're trying to isolate payment. So let's take all of this and bring it to the other side, and since we know FV is 1, we can get rid of that. Payment times the sum of the discount factors is 1 minus DFN, and then divide through by the sum of the discount factors, 1 minus DFN over the sum of the discount factors. Let's see if that works. So 1 minus, there's our last discount factor, 0.9764, divided by the sum of the discount factors. There's your par rate. That is the easiest way to calculate a par rate. All right, LOSH. LOSH has us defining forward rates and calculating spot rates from forward rates. Now you may say, hang on a second, LOSG. I thought we had to look at the spot curve, the par curve, and the forward curve. We didn't do the forward curve. No, we did not. It's hard to do the forward curve without understanding what forward rates are. So we're going to just sort of put that on hold right now. We'll come back to the forward curve. Let's take care of LOSH. Let's look at what our forward rates are and how we get forward rates. Then the forward curve will make a lot more sense. Just a little spoiler alert, the forward curve is just a mathematical result of the spot curve. We don't actually observe forward rates, we calculate forward rates from spot rates. And it's just a mathematical equality. That's all a forward rate is. So let's have a look at what we have. The forward curve is based on forward rates. A forward rate is a rate that's agreed on today, and it's either received or paid in the future. So let's say that in a year, I want to make a deposit at a bank. Not today, but a year from now. Well, what interest rate am I going to receive? I don't want to take the chance in the market that rates are going to go down and I'll get a lower return. Let me enter into an agreement today to lock in the rate that I'll receive in a year for a 1-year deposit. Well, that's called a forward rate, because it hasn't happened yet. We're making some rate in the future. Well, we're going to see that if we have R1, which is a spot rate on a 1-year deposit, and we have R2, which is a spot rate on a 2-year deposit, we can figure out what the rate would be in 1 year for 1 year. That's called a forward rate. And forward rates are quoted on a when-what basis. Just have a look at this. The textbook gives you this example. Typically, it would be written as follows, but let's just look at the way they wrote it. 2y, 5y. This is when what? An agreement on a rate. When? In 2 years. What? A 5-year rate. So 2y, 5y, when we see this, we say, okay, well, that's a rate that's going to start in 2 years and last for 5 years. Typically, we would write it as f and then in brackets 2, 5. 2 implying in 2 years, 5 implying for 5 years. That's the more common way to write it. All right, so we get what a forward rate is. Implied forward rates are calculated from spot rates. We call them implied forward rates because if we have the spot rate, we can calculate the forward rate. In other words, these forward rates are implied by the spot curve. So let's look at an example. Let's take a 3-year spot rate at 3.615% and a 4-year spot rate at 4.18%, and let's calculate F31. F31, what is this? This is a forward rate that starts when? In 3 years and lasts for 1 year. And to do this, we need a 3-year spot rate and a 4-year spot rate. You just add the two. we need a spot rate that corresponds to the first number, and we have a 3-year. Add the two together, you get 4, which means we need a spot rate that corresponds with year 4. If we were going to find a spot rate for F43, we would need I said that right, if we were going to calculate a forward rate, we would need a spot rate that corresponds to a 4-year spot rate, and add the two together, 7, we would need a 7-year spot rate to be able to calculate F43. That's how easy this is. So let's draw a timeline just so that we can see visually what we're solving. Here's our 4-year spot rate on the bottom, 4.18%. That's 4.18% per year. And we're going to use a semi-annual bond basis here. So that means we get paid every 6 months. It's going to compound every 6 months. So there's actually, since this is 4 years, there's actually 8 compounding periods in here. Here's 3.65% per year for 3 years, again, on a semi-annual bond basis. And here's the rate we have to solve for. And this is how easy it is. We want to make sure that there is no arbitrage. So forward rates are sometimes referred to as no arbitrage rates. That means that there's no free money to make. So let's take $1 and let's invest it for 3 years at 3.65%. At the end of the 3 years, we'll invest it for this 1-year rate and we'll come up with some future value. Let's also take that same $1 and invest it at 4.18% compounded semi-annually for 4 years, and we'll end up with some future value. Those two values should be identical. Well, that's how we solve for this particular rate. So 1 plus, here's our 4-year rate divided by 2 because it's semi-annual to the power of 8. 4 times 2 is 8, must equal the investment on the top of the line. 1 plus 0.0365 divided by 2 to the power of 6. 3 years, semi-annual, that's 6. Plus 1 plus, there's the forward rate. This is what we want to solve for, divided by 2 because it's semi-annual squared. And just simplify. Well, this term over here in brackets is 1.0209 to the power of 8. We can simplify the brackets in here, and we know that, well, since these two are multiplied, if we just divide through, we can move this to the other side. So let's do that, 1.01825 to the power of 6. Let's get rid of the square term on this side by taking the square root of this side, so there's a half. Let's get rid of the 1 by subtracting it from both sides. There you go. If you solve for this, you'll get F31. We get 0.0289152. Then we'll just multiply by 2. I should have said this is F31 over 2 because we didn't get rid of the 2. Typically, we would put the 2 on this side, and we would arrive at 0.0577829. That is F31. And you can satisfy yourself that that works. Take $1 and invest it at 3.65% per year for 3 years, compounded semi-annually. Whatever future value you get, then invest it for 1 year at 5.778% compounded semi-annually and see what total you get. Then take your same $1 and invest it at 4.18% per year compounded semi-annually, and you should get the exact same future value. Okay, let's derive some spot rates from forward rates. And let's say this is the structure of our forward rates. The current 1-year spot rate is 1.88%. Then we have a series of 1-year forward rates, 1 year from now, 2 years from now, and 3 years from now. So to get a 2-year spot rate, we'll take the current 1-year spot rate multiplied by the 1-year forward rate 1 year from now. Take the square root of that, take out the 1, 2.324%. For the 3-year, we could take the current spot rate multiplied by the next year forward rate, multiplied by the next year's forward rate, take the third root, take out the 1, 2.728%. Or we could take the 2-year spot rate, square it, and multiply it by the 1-year forward rate for the 3rd year, take the third root, 2.728%. Notice that these two here should be the same because multiplying these two, since we're taking the third root, it's implied we're taking the square root of these two, should equal that rate there. And the 4-year spot rate, the current spot rate, multiplied by the next 3 1-year forward rates, the fourth root, or take the fourth root, 3.074, or we could take what we've already calculated for the 3-year spot rate, put it to the power of 3, multiplied by the forward rate in the 4th year, fourth root again, 3.074, and this should be the same. because everything that we have up here is this rate here. Nice and easy. Compare the spot curve, par curve, and forward curve. All right, this gives us a chance to tidy up the rest of LOSG, the forward curve. Now that we know what a forward rate is, we've seen how to calculate the forward rate. Nice and easy. Let's draw out these curves. Look at the two charts I have at the top. Look at the red line. That is the spot curve on both. We have an upward sloping spot curve. On the other one, we have a downward sloping spot curve. We have already seen that if we have an upward sloping spot curve, we have an upward sloping par curve. The par curve will lie below the spot curve. If you have a downward sloping spot curve, you will have a downward sloping par curve, but the par curve will now be above the spot curve. The forward curve is the opposite relationship. If you have an upward sloping spot curve, you will have an upward sloping forward curve, but the forward curve will lie above the spot curve, and it will lie below the spot curve if the spot curve is downward sloping. That makes a lot of sense. Think about a 1-year spot